Good morning, everyone. So today I wanted to talk about what's happening with the banks and what I think is going to truly be happening with our economy as well. So as we know, one of the banks in Silicon Valley um, basically went bottom up. They didn't have enough money to sustain themselves, and a lot of people lost money banking with that institution. Here's the thing that we know: the FDIC insures up to $250,000. And in that particular bank in in Carolina, had millionaire investors within that bank. In fact, the majority of them were multi-millionaires, which means it wasn't for the average banker. It wasn't for the average consumer. Does that mean it was right? Absolutely not. But I'm just trying to draw some context. The rich of the rich were the ones in that bank. And for whatever reason, that bank was unable to sustain themselves, and that's why they collapsed. Now, today, as I'm making this video, we see the other banks like JP Morgan Chase going down in value, going down in value. Once this video comes out, this may already start to happen. You might already see higher loan requirements and higher interest rates coming out for loans. And this is why I believe banks won't be lending to one another, because the Fed has raised interest rates so much that the cost of loaning money is going to be so much higher. So banks will rather incentivize their current customers to continue to save money. And how they'll do that is by increasing their rates that they pay you. So instead of 3.75% at certain high interest bank accounts, they might raise it to 4% instead of paying 6 or 6.5% to lend with other banks. Car loans, housing loans, all those other things, those will increase as well, maybe by half a point or whatever, in order to ensure that when they do lend out money, they're making a significant profit, in order to ensure that when they lend out money, they are able to cover their bases, they're able to cover their behind. One person is paying for two people rather than one person paying for one person. So if one person ends up not making their payments, they'll still be fine. They'll still be in motion. Obviously, the alternative to that would be to lower rates on consumers and have them make a better ability to pay the debt off, which means you have consumers with a little bit more money in their pockets and the ability to continue to pay, even if, let's say, they lose their job for a quick second, or 30 or 60 days, right? Because with the higher rates, they may not have the option of not working for a short period of time and then have to default on the loan. Whereas a lower rate might allow them some wiggle room in order to bounce back, especially those with good credit who are typically good with their savings and things of that nature. So, again, I am going with the perspective that they're going to increase rates, understanding that jobs are going to be lost, understanding that some people will default on their loans, but they need to ensure that those who do pay them are paying for the majority rather than just themselves, because now it's those who have good credit who honestly will be taken advantage of. And those who have bad credit will either be sidelined from the market or be incentivized, depending on the bank, to take out certain loans with little bonuses, like first-time purchases, things like that, right? Why do first-time home buyers get so many incentives to purchase a home, right? I mean, there's several reasons for it. They don't have the best credit in the world. I mean, I had excellent credit at the time, but I would say the majority don't, right? So why would you incentivize those who have less than subpar credit to go and continue to buy? Well, certain banks will, because they're interested in the transaction. They're interested in selling off the portfolio rather than actually keeping the customer, keeping the buyer, right? You're just a number on a spreadsheet. for the majority of banks. And, so certain banks have different business practice, different measures, and different wiggle room. But I'm speaking for the majority. They're probably going to look to increase the rates in which they give. They're going to look to lessen requirements while increasing rates. So if you can't afford it, you simply won't be able to take out a loan. Obviously, I believe people are going to pull money out of the banks, especially if they have over 250. But those who don't have over 250 will also be pulling out because they may not just be educated on the market at all, and they may believe that their money isn't safe. With the stock market going down as well, on the banking sector, we'll see CEOs try to take some action because obviously that affects their pockets. And, which direction will they spearhead? Which direction will they go into? Probably more layoffs in the banking sector, trying to trim the fat even more and see where they don't need to be paying people. And so that's my prediction moving forward. I post every single day at 8 a.m. daily. Make sure you comment down below what you would like to hear and what are your thoughts on this banking industry right now in the U.S. Let me know in the comment section again down below. Like, it truly helps the channel out. Subscribe, that will also truly help the channel out. I post every single day at 8 a.m. daily, and I can't wait to see you on the next one. Peace.